Good afternoon to everybody. My name is David Levy-Faur, and we are recording this seminar in a webinar on theories of regulation. Our effort in this direction is in order to kind of contribute to the development of regulation and governance theories and institutionalization as a field, a research field, a growing research field. And today we are happy to have to host Agnieszka Smoleńska. And Agnieszka is assistant professor at the Institute of Law in the Polish Academy of Sciences, and also a postdoctoral fellow at the Hebrew University of Jerusalem. She's dealing with financial regulation, EU economic governance, focus on sustainability and transition, the green transition. Thank you, Agnieszka, for being with us. I will also mention the title of the talk to save you some time: Integrating Sustainability in Financial Supervision, exploring the complementarities across institutional contexts. Agnieszka, thank you, and the floor is yours.
Wonderful. Thank you so much, David, and thank you everyone for joining today. I will start, as it was clear from the introduction, I'm a lawyer, which means that this kind of institutional analysis is something that I'm that is helping me understand better what law does, and that's a little bit the perspective with which I'm coming to this topic. What I'll be discussing today is specifically. Can you see, can you just confirm that you can see the slides okay?
Yes,
in full screen?
Absolutely.
Okay. Excellent,
yes.
Fantastic. Great. So what I'll be discussing today is basically how different supervisors across a number of selected jurisdictions, and I will explain my case selection in a moment, how they integrate sustainability concerns in what they do. And I will use a kind of institutional analysis, looking at institutional design and also democratic qualities of such supervisors to try and see whether these institutional features explain anything at all about why, about the choices that supervisors take, and if based on the findings of that analysis, whether we can draw broader conclusions in both with regard to sustainability transition specifically, and kind of more broadly the structure of financial oversight. So I'll start by explaining to you, and maybe because it's even setting up this question to people who are specializing in governance-related issues seems absolutely maybe a little bit shocking is a strong word, but it might be surprising. Of course, institutional context has to have a bearing on the choices that supervisors make. But I hope to, in the first part of the presentation, I hope to make you understand why, for some strange reason, or perhaps not so strange, the institutional context within which supervisors make certain choices, and by institutional context, I mean specifically the mandate, type of supervisory architecture they are in, whether they are only supervisors or whether they are also regulators. This has been largely sidelined in a lot of the analysis of sustainable finance. Now, this trend is still nevertheless enormous, and I would say that this is in this very quickly progressing field really an area that deserves more attention. We see also a global convergence, so there is an understanding that sustainability is a risk that needs to be addressed in the financial sector, but there is significant heterogeneity of approaches. And I'll be focusing specifically on the leaders of this trend, just to show that even among the, let's say, quote unquote, top supervisors, we can observe significant variance. And I'll be looking at specific institutional explanations related to the terms of the delegation or the democratic qualities, and that's obviously drawing on Libby Maman's recent paper, which I found very helpful and kind of giving me a new lens to look at this issue that has been, I can say, bugging me for quite some time. And I'll conclude with some exploration of complementarities and implications for these kind of multi-level governance structures. So what I'm doing essentially is looking at what the best-in-class supervisors when it comes to sustainability are doing, the European Banking Union, Sweden, Hungary within the EU. And that already should tell you something about the scope for variance even within one legislative regulatory area. UK and Brazil. And what I've done first is to look at how these supervisors have been incorporating sustainability in how they exercise their mandates, how they pursue their objectives. And I've developed kind of these differentiating features. The second step was to look at the institutional design and the extent to which it can be explanatory of such differences I've identified, specifically the terms of the delegation and democratic qualities related to accountability, transparency. There is some overlap between these two, but I'll come back to it. And I also hope that this could be something that we can discuss towards the end. So starting with the motivation, and the motivation I think is quite clear. So this is the front page of BBC Today, extreme heat across Europe. There is also an increased understanding that a lot of this climate change is also made or even accelerated by choices made by financial institutions and how they allocate capital, specifically. There's an annual report published by a number of NGOs, which highlights the significant number of funds that is directed by banks towards fossil fuel companies, maintaining high level of CO2 emissions, etc. Now, there is at the same time, there is a number of supervisors, especially since 2015 speech of Mark Carney, the then governor of Bank of England, who drew attention to the tragedy of the horizon. So there is this understanding that supervisors should be doing something about this, that this is the climate change and broader sustainability issues, that they may undermine financial stability, that they pose financial risks to the balance sheets of financial institutions. And that is even before we even start to consider whether, for example, supervisors and legislators could engage in some sort of credit guidance to facilitate the diversion of funds towards sustainable activities. Now, the question that I ask is, why do some regulators and supervisors take action, and why do they take a particular type of measures rather than others? And I'm really curious, and this is again something that I think has been so far unexplored, to what extent institutional features matter in the choices that supervisors make. And more broadly, in kind of more theoretical also level, I'm interested about the implications of any such findings for institutional design of highly technocratic agencies in an era of kind of paradigm shifts and existential threats, the rise of political, or the re-emergence of political economy analysis and across different social science fields, also in law now as well. So to show you the trend, this is the number of ESG regulations per region from a UN database. Clearly, there is an explosion of these types of measures. They are hugely diverse, and I just wanted to show you on this slide and the next one just the number of different typologies that are also being developed to differentiate between the different types of regulators across different geographies also. Europe is clearly the leader. in this space, but by no means the only one. We also see a high number of sustainable finance regulations in Asia, and I'll also be discussing the South America example of Brazil, which in many ways which is maybe not visible on this graph, but Brazil was absolutely one of the front runners of this trend. There is a huge diversity of these types of measures which are being introduced. So some are binding, some are non-binding, some are developed by legislators, the executive agencies, at national level, regional, international. Some are applying to the whole business sector, to all corporates. Others are just focused sectorally. Here I've kind of grouped these measures into 7. You can never resist the temptation to make a taxonomy when presented with the opportunity. So here I would differentiate corporate governance related measures such as disclosure, due diligence, definitions. So these are typically green taxonomies that provide a definition of what is considered sustainable, labels related to specific financial products such as green bonds, monetary policy related measures, that is, for example, greening or tilting of asset purchases or collateral policies of central banks. There are some measures related to investor protection which are being introduced, and more generally the public policies introduced by governments to stimulate the development of the market. So this might be done through either sovereign green bond issuance or specific fiscal policies, tax incentives, etc. But the one area which I'm most interested in, also because I've been working on banking regulation now for over a decade, are the prudential rules at both micro, so individual financial institution, and macro level. And arguably, this is also the area which can be within the sphere of sustainable finance, of course, setting for the moment aside the kind of broader sectoral transition policies. Within the world of sustainable finance, prudential rules are arguably the most consequential because they will have a direct impact on capital flows and allocation, but at the same time, they are quite complicated institutionally. So the rise of prudential sustainable finance regulation refers to the progressive riskification of sustainability factors, with these sustainability factors related to environment, social, and governance, but predominantly climate change in the context of banking regulation. These are treated as drivers of traditional risk categories, so credit, market liquidity, operations-related risk, which means that prudential supervisors have to take them into account in how they exercise their supervisory tasks related to ensuring that there is adequate capital within the bank, that it has the right processes in place to manage the risk related to these sustainability factors. So these can be both in the context of climate change, physical risks related to floods, for example, and the impact that this may have on real estate values, right? As well as transition risks. And transition risks are those risks that are related to policy change, for example, and the risk that some exposures on bank balance sheets, for example, the exposures to highly emitting activities which are today super profitable, but tomorrow will be banned by public policy. This is also a risk that needs to be managed by banking institutions. That's the kind of the risk-based idea behind prudential sustainable finance regulation. And there are a number of different ways to do this. And in kind of global and EU levels, there are a variety of approaches. So some that focus largely on, within this kind of general approach of treating sustainability factors as drivers of traditional risk categories. There are some differences relating to, for example, whether you just look at climate change related risks, so the transition and physical risk I just mentioned, or whether you also more broadly incorporate environmental and social related risks. There is also a difference in perspective, but for the sake of time, the main point is that there are some differences at the international level, even though there is a very visible global convergence towards understanding that these are material risk factors. Now, at the same time, we have huge differentiation in what the individual supervisors are actually doing. And here I'm presenting you with two different kind of classifications. This is a very fertile area for kind of public advocacy type activities. So this is WWF, making a kind of ranking of which are the supervisors that are active or less active. The dark blue ones are the most advanced, quote unquote, supervisors, and the gray ones are the least active. Here is another one. This is Positive Money, another kind of public interest NGO, and they even made a ranking on which central banks and which financial supervisors are the most active and score the highest in terms of their positive impact on, quote unquote, greening the financial sector. Now, what I think is really missing in these comparisons is this governance institutional perspective. Very few of these comparisons really pay attention to who is the regulator, who is the supervisor, whether the supervisor has responsibility just for the banking sector or also for insurance, what is the scope of their powers. It's as if we are largely extrapolating the kind of practices of select jurisdictions where there are central banks in the driving seat and hugely obscure the institutional diversity which exists in the world of financial oversight architectures. So, and I think this is a huge omission, because incorporating this institutional governance perspective is hugely important from the point of view of understanding policy choices that these supervisors make. There are theoretical implications, of course, of this. To what extent does institutional design, and here like institution, whether that matters or not, and of course also it would serve to better inform kind of advocacy objectives. So what these guys want to achieve in the first place. Now, also when it comes to academic research in this area, we see this is very much reflected. This is very much visible. So the institutional analysis of sustainable finance regulation typically focuses only on central banks and their mandates. So whether this has an impact on the type of choices that they make with regard to sustainability. Regulators and supervisors are typically collapsed into one authority, so there is no differentiation between who is the rule maker and who is the enforcer, which is this very characteristic perspective in the context of financial oversight. So this differentiation between who sets the rules and who supervises them, and this broader supervisory process. This structure of oversight, whether it's everything, all the responsibilities for the different types of activities, whether that's centralized within the central bank or dispersed among a number of institutions, that's largely ignored. And kind of the dominant explanations for why central banks, some central banks, for example, take action is mostly done by looking at kind of this agent perspective, bureaucratic entrepreneurship kind of explanations. Where there has been some thought as to how the structure, institutional design impacts on whether financial supervisors can achieve their objectives or not, has been largely focused on central banks and their ability to achieve a primary mandate, including in regulation and governance 2 years ago. But largely here with the especially after the financial crisis, there has been this broad acceptance that the structure of oversight actually doesn't matter that much for the achievement of the objectives, which I hope to challenge a little bit here, though you'll see it's not so easy. So this is where this idea came to my mind, to kind of see what the supervisors, the best-in-class supervisors, are doing, and whether there is an extent to which we can explain their differentiated choices even among the top of the class, quote unquote, by the terms of the delegation, so the scope of powers that they have, the structure of oversight, so how are tasks divided for the oversight of the financial sector, the definition of the mandate, whether it's a more of a broad one that also makes references to sustainability objectives, or whether it's it's a narrow one, so typically ECB always given as that one example of a narrow mandate kind of supervisor, and what are the levels of independence. And secondly, and this is in the second step, something that I'm still exploring and working on, to what extent democratic quality, so this is drawing on Libby Mammon's work, whether that can be more helpful. So looking at the accountability, transparency, representation, and participation involved in the design and implementation of policies related to sustainability risks in banking activities. So the five case studies I've already mentioned. So I wanted to look at the central banks that are really the top of the list in all of these comparative NGO rankings. Do they differ? Does it matter? How does it matter? Now, from this comparison, which I've done looking at the different types of binding or non-binding guidance coming out from these institutions, communications coming from these institutions, different types of research projects that they've been pursuing, speeches of supervisors, as well as interviews, I kind of came up with these 6 differentiating features. So first, which tool do they reach for, whether within the existing toolbox of prudential supervision, whether it's kind of more direct and far-reaching and kind of horizontal capital requirements tool, or whether it's more of looking at integrating sustainability concerns and individual supervision of different banks. So that's this kind, which tool do the supervisors reach for? The second is the perspective. So whether it's a perspective looking only at climate, environment, and whether it's one that looks at the issue of sustainability from the perspective of financial materiality, so only how changes in policy, physical risks materializing will impact on the bank balance sheets, or whether the supervisors are also open to thinking about how the choices that the banks make in their strategy, their business models, how they may contribute to exacerbating environmental and climate change risk in the medium term. A third kind of differentiating feature was how the kind of extent of regulatory tool, repurposing of existing regulatory tools or regulatory innovation. And with some supervisors, we really see the creation of new regulatory instruments, which then have a bearing on these original the main tool on the main tools, so supervisory processes, kind of capital requirements which are being imposed on bank balance sheets, which are the most, in a way, crude tool of guiding how a bank manages their risk, or whether supervisors, and this is also the case for some, they are very careful to introduce new tools, but make clear that there is a very distinct line between this new innovative climate change related in types of interventions and the traditional prudential toolbox, which relates to how much capital a bank should hold and the different types of risk models that are being used for that purpose. Fourth kind of distinguishing feature, the granularity of the rule, so how prescriptive it is. Is it, like in the case of the ECB, a 60-page guide which details with quite a lot of details quite significantly the types of things that a bank should be looking at in the context of sustainability risk? Or is it a few pages published by the Swedish supervisor, very generic, which kind of gives you the impression that it's the content of the rules is really worked out more in the individual interaction between the supervisor and the bank rather than in this more open way. Then communication intensity and different types of interinstitutional collaboration, and I a little bit accelerate. So unsurprisingly, since I explained to you these differences and distinguishing features, there is a lot of variance in what these 5 leaders, quote unquote, are doing. So ECB is doing a lot of, even though it has no regulatory competence, it's doing quite a lot of innovation in terms of the types of tools that it reaches, in terms of high intensity of communication, a lot of engagement and interaction with other authorities within the EU multi-level framework, whereas in some, in the UK, for example, this is much, there is leadership and interest in the area, but it's much more clearly distinguished that this is the climate change related type of our activities, and this is the kind of traditional prudential approach. Where we see some of the most kind of new tools being used are in Hungary and Brazil. So I mentioned already that Brazil was one of the first financial supervisors to really incorporate sustainability in the assessment of internal capital adequacy, for example. So these are kind of these highly very concrete risk management instruments. And Hungary, which has introduced as well as one of the only jurisdiction from the ones that I studied, the preferential capital requirements for green loans. So the idea is that if a bank lends to an energy efficient house, like for the purchase of an energy efficient house, this is less risky on the bank balance sheet. So very kind of innovative way of using this of using the existing prudential framework. So even among the leaders, we observe significant variance. Now this is coming back to this question: did the terms of the delegation matter, first of all? So the scope of powers, so whether it's rulemaking or only supervision and enforcement, the structure of oversight, mandate, and independence. So far, and this question is very important here. I just show you because it's notoriously complicated, the US financial sector oversight. So these are all of the different types of agencies that are responsible for different segments of the financial sector. So far, largely, as I mentioned, the kind of terms of delegation in the context of climate-related prudential risks have been explored largely in the context of mandates of central banks. And this has, and I say this with a tear in my eye as a lawyer, very limited explanatory power. So it really, you have a number of supervisors and even central banks that have an explicit sustainability related mandate that do nothing about climate change related issues. And you have some like the central banks who have managed to so creatively interpret their own mandate that they are able to do much, much more. But here I was kind of curious about the explanatory force of other institutional features. Whether it matters, whether it's a central bank or a supervisor, whether it matters if the supervisor has a responsibility just for a segment of the financial sector or not, and whether it's a specialized agency or the central bank. And unfortunately, fortunately, there is a lot of heterogeneity in the institutional design of the 5 top green supervisors. So in some, it's a kind of mixed, complicated European banking union system. Sweden has a specialized single supervisory authority responsible only for responsible for the financial sector. Hungary has an integrated central bank, which is responsible for the whole of supervision of and the monetary policy as well. Brazil has a system whereby the central bank is the monetary policy and the banking supervisor, but insurance supervision is separate. And the UK has yet another system which separates the prudential supervision of banks and insurers, which is housed within the Prudential Regulation Authority, part of the Bank of England. So it's within the Bank of England, and that's separated from Financial Conduct Authority, which is a separate independent agency. So when it comes to kind of explaining, does it is this, this perfect example of it looks like it doesn't matter really, right? So there is so much diversity in terms of institutional arrangements, in terms of the mandate. So some, like I mentioned, the ECB's mandate in the context of banking oversight is quite limited. Sweden's is a little bit broader. Hungary's is the broadest, which with an explicit objective to support the government sustainability policy. And Brazil's also because of a particular institutional feature. So there is really a lot of diversity. Now, does this mean that none of these kind of institutional context has no significance at all, given the diversity that we see in terms of what these supervisors are actually doing? So all of these supervisors, despite the institutional context, are guiding the banking sector through a set of expectations and cross-sectoral exercises seeking to develop methodologies. So there is some commonality of approach. It's clear that there is no one institutional architecture particularly conducive to being greened, that is to incorporate these sustainability considerations. But it's true that despite the kind of globally, it's more distributed in terms of the financial oversight between central banks and supervisors. Here, it's largely the central banks. So, with the except of Sweden, in my case, in the case of my research, direct regulatory competences play an important role. So, only Brazil and Hungary have these, but also other supervisors, such as the ECB, managed to go around these limitations in direct kind of lawmaking abilities by having these supposedly non-binding expectations. Still, there are some interesting, I think, takeaways, and two that I would like to draw your attention to is that first, in cases where there's a more limited independence, so supervisors receive explicit political guidance, they appear in my cases to adopt a more cautious and rigorously traditionally risk-based approach. So they are more cautious to separate the formal technocratic task of prudential risk management and this new world of climate change. And secondly, in more fragmented context, this interinstitutional collaboration, kind of joint climate scenario analysis, for example, plays an important role. Now, I also looked, and given this limited extent to which the kind of the institutional design explains much, I thought also about the extent to which democratic qualities of these institutions may be favorable to incorporating sustainability considerations in how financial supervisors calibrate the exercise of their tasks with view to integrate these sustainability risk considerations. And here again, though we see a lot of diversity again, so this is kind of sketching an initial go at this. It's true that largely we see that there is something about especially accountability and kind of a participatory way of designing these policies that may be conducive towards the outcomes that these supervisors are introducing. So here, and this might be perhaps a little bit surprising because given this idea of secretive central banking and banking supervision, we don't typically think of these kind of democratic qualities related to this more openness, inclusiveness relating to representation, for example, or participation. But it's true that in a number of these cases, we see quite a lot of work being put by the central banks into regular publishing of certain types of communications and kind of preparing the regulatory approach in collaboration with market participants and stakeholders. So there is perhaps here this tentative finding, which I hope to refine, that increased democratic qualities perhaps go more hand in hand with green prudential policy, and they are more of an explanatory more of an explanation for the greening of supervisors than the pure structure and institutional design. Now, there are, of course, a number of limitations in what I've presented now. So I've only discussed the leaders of this trend. What about the laggards? And we've also looked at this question in another research, which I'm happy to discuss. I've also, this research, what I've presented focused on a narrow institutional analysis, so formal laws, communications, and that misses some of the more of a strategic communication and indirect supervisory techniques which supervisors may engage with. So I hope to complement this with further, to address this with further interviews. There can be also an objection made that financial supervisors are too special for analysis of their democratic qualities. And finally, there's clearly nothing from of what I've said has really meaningfully engaged with the question of whether this has a meaningful market impact on actually saving us from the climate catastrophe. But nonetheless, we see that there is a rapid progress on inclusion of climate and environmental factors in how financial institutions are supervised. The institutional context may be relevant, but it does not determine whether or not ESG risks are incorporated within the existing prudential processes. Still, this prudential framing somewhat constrains the toolbox. So we see a number of supervisors strategizing depending on how much independence they enjoy, for example, and how they translate this new political salience of this issue into supervisory processes. And I think there's, and this is perhaps the one area which warrants the most research. So there is the suggestion of complementarities between enhanced democratic qualities and integration of sustainability concerns in prudential regulation. Okay, thank you very much for your attention, and I really look forward now to a discussion and your insights.
Thank you very much, Agnieszka. Very rich and very comprehensive presentations that kind of cover a life work almost of working on this. So well done. I'll take questions now from the audience. Anyone wants to start? If hesitating, I would like you, if possible, to clarify the interests, the ideas beyond those policies and institutionalization of ESG policies, and to what extent they are the causes of the change or the reflection of the change, say, in terms of democratic qualities. Yeah, so start with that.
Yeah, thank you so much. So when it comes to there are a number of reasons why financial supervisors would be interested in climate change related risks to bank balance sheets. So the one that I mentioned, and this is kind of the foundational really distinction now, is the single materiality and double materiality idea. So single materiality being that this is just something that is happening that is relevant for how we've already done banking supervision for decades, and it's just a question of recognizing that these climate change related aspects are drivers of existing risk categories, and therefore it's basically what we were missing is information. And now, since we will have more information, it's only natural that supervisors take into account these additional factors. And this is basically not a change in the supervisory structure, supervisory framework. It's just a refinement reflecting the new knowledge about the impact of sustainability factors on financial stability. The second one, yes?
This is the one you support, or?
So I think from a kind of research perspective, I recognize that there is this one, and there's a second one, which is kind of recognizing that with the first one, we are basically squaring the circle, and it just shows you that our definition of what is risk and what counts as possibly material is also determined by different processes, including political and legislative processes, right? So I would say you have a number of commentators, scholars who just point to the fact that this whole pretending that sustainability is a risk is that it's not necessary, and that we basically need more of a credit allocation type policy, just straightforwardly telling banks you can't lend to dirty quote unquote companies and you should only lend to renewables. This is this kind of perspective which is called double materiality. So you have to think only not about the impact that outside has on you, but also how you as a bank impact on these factors. Now, when it comes to how this shapes the different approaches of supervisors, I think here this process of elaborating of supervisory approach and the extent to which supervisors are under scrutiny and pressure from different types of interest groups, both industry and civil society, let's say. I think this you can clearly see in the EU context in particular that this has an impact. So given the high kind of political salience in the EU and the kind of broad consensus around climate change and pursuing sustainability transition, it was much let's say, even for the ECB, which is the king of technocratic institution or queen, you can see that there is more openness towards this than maybe in the case of Bank of England, which is also doing things, but it's doing a little bit of different things. So the ideas definitely shape what the supervisors are doing. And one research paper that I mentioned really kind of studies this, to what extent kind of individual convictions of supervisors within the Dutch central bank have shaped their attitudes towards sustainability. So this is definitely one type of explanation. So I was more interested in kind of this more structural, whether the institutional design also matters.
Thank you very much. And we have Carlos and Marcus. We'll take the both questions in order to stay on time. So Carlos, you first, and then Marcus.
Thank you very much. Thank you very much, Agnieszka. It was really nice to see your presentation. I think next time we have a coffee, I will know a little bit better about your work and we can talk about it in depth. I have a couple of questions. First of all, you chose in your case selection clearly countries who are the front runners. You said it several times when it comes to green supervision. I was wondering how you decided which countries they were, whether you use any specific indicators, etc. Then I also have another comment or question. I was curious when I saw at the beginning of your presentation that you wanted to, you were curious about the implications of this research puzzle to multi-level governance, if I'm not mistaken. So I was wondering if you could expand or elaborate a little bit on this. And given that this is one of your research interests, I was, over the course of your presentation, curious that some East Asian countries are also up there in this area, for example, Indonesia being one of them. So maybe as an idea for a future paper, given that you're curious on multi-level governance, it would be good to incorporate one of these countries, also comparatively, even in the context of maybe an EU country, Mercosur country like Brazil, and an Asian country such as Indonesia. Thank you so much.
Thank you, Carlos.
And with Marcus, please.
Thank you. Oh, sorry, I need to unmute myself. I am.
Yeah, you're fine.
Yeah. Thank you very much, Agnieszka. That was quite amazing and very, very interesting. I wonder, I just read this morning in the UK press that institutional investors have backtracked on support for climate resolution at the oil firms' AGMs. All of the banks which are being regulated are international, most of them are international organizations. Is there any way that these kind of regulations can really impact their operations if they're not on a worldwide scale and done at the level of United Nations or some other financial institution? Because obviously a bank, I mean, I just looked at the first article you put up on the screen about fossil fuel companies. There was a report, and the things that they are doing sound to be totally horrific. But of course, if they're working in one country where the regulations are more strict, then they can go to another country where the regulations are less strict. Yeah. And still avoid being properly regulated. I wondered if there's any way you could address that in your research.
Okay.
Thanks.
I'll just go. Yeah. Thank you so much for the question. So first, the question of front runners. I basically use the WWF Sustainable Finance report that I had in one of the graphs that kind of had these color-coded leaders, and these are I also wanted to kind of have the jurisdictions that were the first and doing something. So that's the reason I basically took the top 5 pretty much, not differentiating within the European Banking Union between Germany and France like they do in some jurisdictions, because then you get in this complicated question of where is monetary policy, where is supervision. Though this brings me to the second part of your second question about multi-level governance, because it's so basically since within the EU we have this quite complicated structure where on the one hand you have the rules made at the level of EU 27, then you have the banking union for the 20 euro area, well no 21 because it's euro area plus Bulgaria within the banking union. And they have very different institutional structures. So when you look, half of the national supervisors within the banking union are central banks, and half are independent agencies. So I was just curious to if that has, since this institutional, there's some aspects of the institutional framework which are consequential for how supervisors deal with sustainability issues. Also these related to accountability, representation, participation, etc. I was just curious as a possibly maybe a future research project to think about how this might work within the European Banking Union, where you have the national supervisors working with the ECB also on these issues, especially since, but this is more kind of policy answer, since the ECB is kind of using this topic also to kind of solidify the supervisory culture within the banking union. But that I should have I thought this is opening another can of worms, so I wanted to delete it from the slide, but then I forgot. But thank you for picking up on this. Yeah, and on the question, thank you, Marcus, so much for the question, which relates to one of the most complicated topics, right? So how do you deal with the cross-border aspect of this, especially since most of the banks in the Banking on Climate Chaos report are within the jurisdiction that was not part of my analysis, namely the US, right? So I think this is these are a few questions related to what national supervisors can still do, in particular in jurisdictions which are hosts to international financial institutions, to still kind of influence how banks operating and established, even if they are part of international groups, how they lend, right? So this is, you still have some competences for the host authorities. Of course, there is a big limitation from the absence of a global framework, but there are some initiatives like the ones that I mentioned in one of the slides. So there is a task force for an FSB, Financial Stability Board task force for disclosures. There are new sustainability disclosure standards also being introduced, and there is this particularly vibrant framework called Network for Greening the Financial System, which currently involves over 100 supervisors and central banks, and kind of looks to do peer reviews and kind of exchanges to kind of address this cross-border question. Of course, we have, said perhaps a centralized solution would be the best, right? But this is not the world that we live in. So, you have the next best explanation. It's all about experimentation and see which one works, right? Yeah.
Thank you.
David, do we have a time for another question?
Yes, Tatiana, please.
Tatiana Jovanik here. I just recently delivered a paper at our conference in Antwerp, and I made a research of climate change agendas of central banks in Central and Southeast Europe. Basically, it's a comparative study. So I wanted to ask Agnieszka whether she discussed in her papers the issue of monetary policy adjustments because in addition to green credit allocation tools, such as those of the Green Toolkit strategy of the Hungarian Central Bank, green monetary policy instruments have an important role in the transition towards a climate neutral economy. And as part of their operational procedures, central banks determine the criteria or requirements for assets and collateral to be eligible for use in monetary policy operations. And just to mention that I discovered not only the Hungarian Central Bank has this policy of introduction of a green bond portfolio within its foreign exchange reserves, I also found that some central banks in my region, so Western Balkans, let's call it, such as Central Bank of Croatia or Slovenia, really have very active policy in terms that the share of international reserves that are, for instance, managed by central banks of Croatia are made up of sustainable investments, green bond, etc. So I think there is a tendency even to have these monetary policy adjustments, not only green credit allocation tools. So my question for Agnieszka was, is whether she made a comparison of those monetary policy adjustment tools in terms of the composition of the portfolios of central banks. And I apologize for not being able to turn on my camera because I'm with my toddler and it's a mess around me. Sorry.
Okay. No worries. Agnieszka, please.
I think also Claire had a question, maybe if it's short. Like I'll
Yeah.
be very brief in my answer.
I'll be very
Please,
brief.
yeah.
If that's okay. Thank you so much for a fantastic presentation, Agnieszka. It was beautifully clear. My question was really about the role of the those indicators and the rankings that you mentioned as technologies of global governance in themselves, and whether that you thought that might be one mechanism that the democratic qualities could come into play. I think that riffs off of Marcus's question about how do we regulate a global problem with particular jurisdictions.
Yes, absolutely. So thank you, Claire, so much. Mindful of the time. Tatiana, if you could send your email in the chat, I'll send you a paper that we have. So I've tried. I did one paper in 2020 comparing what the different central banks are doing, and like basically starting from the fact that some central bank I know best, apparently the way you say it, does nothing. So I was very frustrated. So I wrote an article about it, comparing and showing that the Polish Central Bank was absolutely laggard. And then we kind of went into more comparative, also legal analysis of, but I'll send these to you.
Thank you in advance. Thank you in advance.
There is also a very good paper on, because what is really relevant here is the tenability of Chinese walls between monetary policy functions and supervision functions, which are kind of really reified, I think you can say, in the EU context. So we really love this idea that you can separate, you have one tower of the ECB dealing with monetary policy and another dealing with banking supervision, and never the two shall meet. Whereas clearly in the context of climate change, there is also some evidence that you need to ensure alignment between these two policies to really maximize the effect. So there is another paper in Maastricht Law Journal, but I'll send it to you. I think that's a very interesting question also to think about. So thank you so much. And to Claire, I didn't think about this, but this is clearly, so NGFS does a lot of peer reviews, and kind of clearly by even formulating the framing of these peer reviews, that's a form of harmonization of approaches, right? And it also tells you a lot about which central banks are in that, which still remain outside. So I think you could absolutely make this claim, right? But I would have to think a little bit about this. But yeah. for sure. But still, it's interesting that there is still differences, right? So you have this common framing within which discussion takes place, but it doesn't mean absolute harmonization. There is still kind of path dependency in the different choices at national level that supervisors are making, and kind of, I think, capturing those differences is also really important. So this is what I try to do.
Thank you very much, Agnieszka. It was and is still a very interesting presentation, very clear, very broad in scope, so we learned a lot. The issue touch on the very basic of the politics of society and economics of our time, how democracy can deal with the transition challenge, and to what extent we can trust the system to deliver. So thank you very much for bringing this important issue to us. And thank you also for the audience of taking part. So we see you in the next seminar. Join us, subscribe to our channel. Thank you very much, and goodbye to you all.